Welcome back to the deep dive. I want to start today with a visual.
Okay.
You know that scene? It's in every high stakes business movie, right? The one where the seasoned tycoon is sitting in a diner, maybe a boardroom.
Mm-hmm. Smoky back room.
Exactly. And someone slides this huge, thick binder across the table. It's got hundreds of pages of due diligence, property inspections, tax records, everything.
Right.
But the tycoon, they don't even open it. Instead, they just ask one question. Maybe they scribble a single number on the back of a cocktail napkin, and then they look up and they say, "I'm in."
Or the opposite. You're out of your mind.
Or even more dramatically, "You're out of your mind." Exactly. And for the longest time, I thought that was I thought it was lazy screenwriting.
The classic Hollywood trope of the gut feeling. The idea that, the true experts have some kind of sixth sense that just cuts through all the paperwork.
Yes, a superpower that you're either born with or you're not. But I've recently been sort of wading into the weeds of real estate investing, just dipping my toes in. I realized something.
What's that?
That napkin math isn't a superpower. It's an actual mechanic. There are specific tools designed to let you look at a price tag and almost instantly know if a deal is a total ripoff or, a potential gold mine.
It feels like magic, but it's really just a ratio.
Right. But it feels like a cheat code. And today, we are talking about one of those specific cheat codes. It's called the gross rent multiplier.
Or GRM for short. And you're right to call it a cheat code, but maybe not the way you think. A cheat code in a video game, it lets you skip the hard levels, right?
Yeah.
Gross rent multiplier, it lets you skip the noise. But, and this is the big but we're going to spend the next hour unpacking, if you use it blindly, it can also lead you right off a cliff.
That is the mission for today. We have a stack of sources here, technical definitions, some valuation principles, and a few cautionary tales. And we are going to just completely dissect the gross rent multiplier. We want to move beyond just staring at a Zillow listing and seeing a price that looks like a telephone number.
Right.
We want to understand the relationship between what a building costs and what it actually earns.
And we need to go deeper than just how to divide X by Y. I mean, any calculator can do division.
Right.
We need to understand the psychology of this metric. Why do sellers love it? Why do buyers get tricked by it? And how does it stack up against the adult tools in the room like cap rate and discounted cash flow?
So we're going from the back of the napkin scribble to the why am I losing money on this duplex?
That is the trajectory, yes.
Okay, so let's start with the absolute basics, but I want to frame it practically. I'm scrolling through listings. I see a duplex. It's $500,000.
Okay.
Then I see another one down the street for $450,000. My brain, my immediate gut reaction says the $450K one is cheaper. But that's not necessarily true, is it?
No, not at all. Because you aren't buying the bricks and the mortar, you're buying the income stream that comes with it. That $450,000 building might have tenants who are paying, 1990s rent prices. The $500,000 building might be fully optimized, getting top market dollar. So price alone, it's a completely useless metric.
You need a bridge.
You need a bridge between the price and the income.
Yeah, exactly.
And that bridge is the gross rent multiplier. So if I stopped a real estate mogul on the street...
Assuming they wouldn't call security on you.
Right. Assuming that doesn't happen, and I asked for the plain English definition, what is it?
In the simplest terms, the gross rent multiplier is the ratio of the price of a real estate investment to its effective gross income.
Okay, stop right there. You threw a specific term in immediately. Effective gross income.
Mm-hmm.
Now, I know what income is. That's the rent checks coming in. But why gross and why effective? That's a key distinction.
It is. This is the first hurdle where people get tripped up. When we say gross income in the context of GRM, we're talking about the absolute top line revenue. We're talking about the money coming in the door before a single cent goes out the door. So before I pay the property tax bill.
Yes.
Before I pay the insurance policy for the year.
Yep. Before that.
Before I pay the water bill, the trash collection, the guy who mows the lawn.
Before all of that, when you calculate GRM, you are deliberately, consciously ignoring operating expenses.
Okay, hold on. That sounds incredibly dangerous.
It does.
I mean, if I'm evaluating any other business, I care about profit. I care about what I actually keep in my pocket. So if I'm looking at a property and I explicitly ignore the taxes and the insurance, isn't that just financial suicide? How can that possibly be a valid way to value something?
It does sound reckless, doesn't it? Here, buy this business, but whatever you do, don't look at the costs.
Right.
But think about the napkin scenario you started with. You're at the diner. You don't have the tax bill in front of you. You don't have the insurance quote yet. You need a way to filter the deal now with the limited information you have.
So it's a filter. It's just a first-glance tool.
Exactly. But there's a conceptual way to look at it that makes it a little less scary. Try thinking of the GRM not as a measure of profit, but as a measure of time.
Time.
How so?
Yes. The number you get when you calculate the GRM, it actually represents the number of years the property would take to pay for itself, using only the gross received rent.
Okay, let me try to visualize that. So I buy a building, I take every single rent check I receive, and I just stack them in a big pile in the corner. I don't pay the mortgage, I don't fix the leaky toilet, I don't pay the government their taxes, I just stack the cash.
You just stack the cash.
The GRM is how long it takes until that stack of cash is the same height as the purchase price.
That is the perfect way to picture it. It is a raw, unadjusted payback period.
So following that logic, if it's a measure of time, then faster is obviously better. I want my money back now, not in 100 years.
Precisely. That is the golden rule of the GRM. For a prospective investor, a lower GRM represents a better opportunity.
Because it just means fewer years to pay off the initial investment. Correct. If you see a listing with a GRM of 5 and another one with a GRM of 20, strictly on a payback basis, the 5 is paying you back 4 times faster.
But, and I'm going to play the skeptic here again, if I see a GRM of 5, which sounds amazing, right? Pay it off in 5 years. Shouldn't I be suspicious?
You absolutely should.
I mean, if a building can pay for itself in 5 years, why on earth is the seller getting rid of it?
Now you are thinking like an investor. A very low GRM can be a sign of a fantastic deal, but it is often a sign of a war zone.
What do you mean?
It might mean the area is so risky that investors demand a super fast payback because they don't know if the building will still be standing or rentable in 10 years.
So a low number draws you in, but it might just be a trap.
It's a signal. That's all it is. It's a signal to look closer. But before we get into all the traps, and believe me, there are many, we need to ground this in reality. I want to move away from the abstract. Let's actually do the math.
Agreed. I need to see the gears turning. I have a specific example from our source material right here. And for you, the listener, I want you to imagine you're standing on the sidewalk. You're looking at a nice little rental house, white picket fence, maybe a little garden out front.
Okay, I'm there.
The sign in the yard, or maybe the listing on your phone, says the sale price is $200,000.
$200,000. Got it.
You talk to the agent, or maybe you peek at the current lease agreement that they've provided, and you see that the current tenant is paying $750 per month.
All right, so we have our 2 key pieces of data, the price, which is $200,000, and our monthly rent, $750.
Now, my first instinct, my bad math instinct, is to just grab my phone and divide $200,000 by $750.
Stop! Do not do that.
Why not?
Because you're dividing an apple by an orange. You're dividing a capital sum, the total price of the asset, by a monthly flow. The units don't match up.
What happens if I do it anyway?
If you do that, you get, what, 266?
Yeah, 266.6.
A GRM of 266 would imply it takes 266 years to pay off the building. If you see that number, you're going to run away screaming. You have to annualize the rent first. GRM is an annual metric.
Okay, that makes sense. You have to compare years to years. So step 1, turn the monthly rent into a yearly number. We take that $750 a month and we multiply it by 12 months.
Right. Let's do some mental math. 750 times 10 is 7,500.
Right.
750 times 2 is 1,500. Add them up, you get $9,000.
So this little house brings in $9,000 a year in gross rent.
Exactly. Now we can do the division. Now the units match. We take the price, the $200,000, and divide it by that annual rent, the $9,000.
Okay, I'm punching that into my calculator now. 200,000 divided by 9,000, and the calculator gives me 22.22.
There you have it. The GRM for this property is 22.22.
So let's unpack that result, 22.22. In the vacuum of space, that's just a number. But based on our payback period definition, this means it takes roughly 22.2 years of gross rent to cover the purchase price.
Yes, that's the interpretation.
I have to be honest. 22 years feels like a really long time. I mean, I'll be significantly older in 22 years. And that's assuming I don't spend a single dime on repairs. If I actually have to replace the roof or fix the furnace, it might take 30 years.
It is a significant amount of time. And this is where market context is everything. In a high appreciation market like, say, downtown Los Angeles or Manhattan, A GRM of 22 might actually be considered normal, maybe even good.
Why?
Because investors there aren't just buying for the rent checks. They're buying because they think the building will be worth $400,000 in 5 years. They are banking on appreciation.
So a high GRM is often a signal that people are betting on the property value itself going up.
Or the flip side is it means this property is just plain overpriced relative to what it earns today. It can be one or the other.
And conversely, if I'm in, let's say, a sleepy town in the Midwest, where prices never really change much,
Right. A cash flow
a
market.
GRM of 22 would be terrible. I'd want something much lower, closer to, what, 8, 10?
In a pure cash flow market, absolutely. You'd want to see a GRM of 6, 8, maybe 10. You want that money back fast because you can't count on the building doubling in value overnight.
So the number 22.22 isn't inherently good or bad, it just gives me a benchmark.
Exactly.
I can now look at the house next door. If the house next door is also earning $9,000 a year, but it's selling for only $100,000,
Then its GRM is roughly 11, 100,000 divided by 9,000.
and suddenly the $200,000 house looks ridiculous.
Exactly. And you didn't need to see the tax bill or the insurance statement to know that. You just compared the multipliers. That is the power of the shortcut.
And there's always a but with these shortcuts, isn't there? We touched on a trap a moment ago when I almost divided by the monthly rent. I want to double click on that because our source material really highlights this as a major point of confusion for new investors. The whole monthly versus annual trap.
This is where rookies get embarrassed. Or worse, they make really bad offers.
The source material says that historically, and apparently in some circles even today, people do, quote, GRM based on monthly rent.
Yes. It's much rarer now in professional circles, but it absolutely happens. Sometimes you'll see an old school broker who just says something like, oh, this place is trading at 100 times rent.
100 times rent. That sounds catchy, I'll give them that.
It does, but he means 100 times monthly rent.
Okay, so let's look at the math conversion that's provided in the source. It gives a very specific example. It says a GRM of 100 calculated on monthly rents is actually equal to an 8.33 GRM calculated on annual rents.
Right. Let's break that down so it's crystal clear. If someone says the GRM is 100 based on those monthly numbers, they mean the price is equal to 100 months of rent.
Okay, 100 months of rent.
Yeah. So how many years is 100 months? You just divide 100 by 12.
And that gets you 8.333 repeating.
Exactly. So if you're looking at a deal and you see GRM 100 and you panic thinking 100 years to pay this thing back, you've just misunderstood the unit of measurement. It's actually an 8.33-year payback, which is quite good.
And the reverse is true, too. If I see a GRM of 8.33 on a flyer, and I just assume it must be monthly.
You'd think, wow, the house costs just 8 months of rent. I'll take 10 of them.
Right. In our example, that would be an 8 times 750. A $6,000 house.
Exactly. So context clues usually save you here. If the number's up in the hundreds, it's almost certainly a monthly figure. If it's in the single or low double digits, it's annual.
But the big takeaway is never assume. Just ask the question, are we talking monthly or annual? Because the difference is a factor of 12.
And in finance, being off by a factor of 12 is, it's the difference between retiring early and going completely bankrupt.
Okay, so we've got the math down. We understand the 22.22 figure. We know to always use annual rent. But I want to go back to this uniformity issue. I'm still stuck on the idea that we're just ignoring all the expenses. You said earlier that it works because of uniformity. I need you to convince me because my skepticism meter is still kind of redlining on this.
Fair enough. Let's try a different analogy. Imagine you're buying a used car. You're looking at two absolutely identical Toyota Camrys. Same year, same mileage, same condition. They're parked right next to each other.
Okay, I can picture that.
Do you need to calculate the exact cost of gasoline for the next 5 years to figure out which car is the cheaper one to buy?
No, of course not, because they get the same gas mileage. The gas cost is going to be the same for both of them.
Exactly. The gas is uniform. So you can safely ignore it for the comparison and just look at the sticker price. That is a fundamental argument for using GRM in real estate.
So if I'm looking at two nearly identical apartment buildings,
Yeah.
and they're on the same street,
Right. They're in the same county, so the property tax rate is going to be the same percentage for both. They were likely built around the same time with similar materials, so the insurance risk is probably pretty similar. The tenants in that neighborhood, they probably all pay their own electric bills.
so the overall expense profile is roughly identical between the two.
That's the assumption. Exactly. If building A uses, say, 40% of its gross income for expenses, then building B probably uses about 40% too. So if you just compare the top line numbers, the gross income, the ratio holds true. You don't need to do the heavy lifting of calculating the net income to know which one is the better relative value.
Okay, that makes sense. It's a relative tool, not an absolute one. I'm not saying this is a good deal. I'm saying this is a better deal than that one.
You've got it. It is useful for comparing properties where those operating expenses are expected to be uniform. Our source material lists specific things that we can often consider uniform: depreciation effects, periodic costs like taxes and insurance, and any tenant-incurred utilities.
But what happens when they aren't uniform? What if I'm comparing a brand new building with, super efficient HVAC and new windows to a 100-year-old building with a leaking boiler and drafty single-pane windows?
That is where GRM breaks. Completely and utterly breaks down.
Because the expense profile is totally different.
Wildly different. The old building might have a great GRM on paper. Maybe it's cheap and has high rent. But if 60% of that rent is going straight to the gas company to run that ancient boiler and to pay for constant repairs, the GRM is lying to you about its profitability.
So GRM is blind to efficiency.
It is blind to condition. It's blind to the quality of management. It's blind to everything except for two numbers: the price and the rent.
So why do we use it? I mean, really, if it's blind to all the things that actually cost me money, why not just always use the net income? Why ever bother with GRM?
Because getting the net data is hard. And frankly, it's often unreliable when you're getting it from a seller.
Is it? I mean, isn't it just on a spreadsheet somewhere?
Think about the seller's motivation. They want to sell the building for the highest possible price. Do you think they're going to proudly advertise that they spent $15,000 fixing a major sewage backup last year?
Probably not. They'd probably call that a one-time capital expenditure and try to hide it or explain it away.
Exactly. Or maybe the owner manages the building themselves to save money so they don't list a management fee expense. But you, the buyer, you live 3 states away and you're definitely going to have to hire a manager.
Right. So their net income from last year is going to be artificially higher than my net income will be next year.
Exactly. Net income is a slippery number. It depends heavily on who is running the building and how they account for things.
But gross rent.
But gross rent is usually a bit more public. You can look on Zillow or Craigslist to see what similar units are renting for. You can, in theory, ask the tenants. It's a harder number for a seller to completely fudge. And our source makes this point: costs like repairs are often harder to predict than the market rental return. So, GRM serves as an alternative when a true measure of net investment return is just too difficult or unreliable to determine.
It's the quick and dirty tool. It's the tool you use when you don't fully trust the seller's expense report.
Or when you don't have it yet, it's the scout that goes out ahead of the main army to survey the terrain.
Okay, I like that analogy. The GRM is the scout. But eventually, the army has to arrive. Eventually, you have to look at the real profit.
Yes.
And that brings us to the big rivalry in real estate math. Section 5. GRM versus the cap rate.
This is the heavyweight championship. If you hang around real estate investors, you will hear the term cap rate 10 times for every one time you hear GRM.
Oh, yeah. What's the cap on that? I'm looking for a 6 cap. Sounds very sophisticated.
Yep.
So how does this relate to our humble little gross rent multiplier?
They're effectively siblings, but one is the optimist and one is the realist.
Okay.
The GRM, as we've established, is based on gross rental income. It ignores all the bad stuff. The cap rate, or capitalization rate, is based on net return.
So cap rate does include the expenses.
Yes. The formula for cap rate is the net operating income, or NOI, divided by the price. It peels back all those layers of taxes, insurance, and maintenance to see the real profit yield of the property.
There's also a structural difference in how the number is expressed, right? GRM is a multiplier, a number like 10 or 12. Cap rate is always a percentage like 5% or 8%.
Right. And this is another thing that confuses people. One is a timeline, how many years to pay back. The other is a yield. What percentage return am I getting on my money this year?
Is there a mathematical link between them? Or are they just two totally separate universes of metrics?
Oh, they are deeply connected. In fact, our source points out that a multiplier derived from net return would be the multiplicative inverse of the cap rate.
Whoa, okay, multiplicative inverse. You just lost half the audience with that one. You're going to have to unpack that without the textbook.
Let's try an analogy. Think of a seesaw. On one side of the seesaw, you have the cap rate, which is your return. On the other side, you have the multiplier, which is the cost in years.
Okay, I'm with you. Seesaw.
If the return goes UP, meaning the deal is more profitable and you're making more money, what happens to the time it takes to get your investment back?
The time goes down. If I make more money each year, I get paid back faster.
Exactly. So as the cap rate goes UP, the multiplier goes down. They always move in opposite directions.
Give me some actual numbers.
Okay. Let's say you have a property with a cap rate of 10%. That means you are earning 10% of your initial investment back every single year in pure profit.
Simple enough.
So if you earn 10% a year, how many years does it take to get 100% of your money back?
10 years. 10 times 10% is 100%.
Exactly. So a 10% cap rate is mathematically equivalent to a net multiplier of 10. Now, what if the cap rate is only 5%?
Well, if I only make 5% a year, it's going to take me twice as long, 20 years to get to 100%.
So a 5% cap rate is a net multiplier of 20. Do you see the seesaw? The rate got cut in half from 10 to 5, and the time doubled from 10 to 20.
That is actually a really helpful visualization. There are just two different ways of asking the same fundamental question. One asks, how much cash do I get this year? And the other asks, how long until I'm whole?
With the major caveat, of course, that GRM uses the gross numbers and cap rate uses the net numbers. So they will never match up perfectly in the real world.
Right.
But the relationship holds. If you see a property with a low GRM, you should expect to see a high cap rate. If you see a high GRM, you should expect a low cap rate.
And what if you see a low GRM and a low cap rate?
Then the expenses are enormous and you should run away as fast as you can.
Right. That would mean the building brings in a lot of rent, but it costs an absolute fortune to run, so there's no profit left.
Precisely. That's why you have to look at both. The scout reports back, then the Army does its own analysis.
Now, speaking of looking at the numbers, we need to talk about where the numbers themselves come from, because this brings us to Section 6, variations on the theme. And this, I think, is where most people actually lose their money.
You're talking about the data source problem. It's a huge issue.
Yes. First, a quick terminology check. I've seen the term Jim Gross Income Multiplier. Is that different from GRM?
Not really. For our purposes, GRM and GIM are used essentially interchangeably. Sometimes income in GIM is meant to imply other sources of income, like laundry money or vending machines in an apartment building, but usually it's the same math.
Okay, so GIM is fine. We don't need to worry about that.
Yeah.
But the real danger is the difference between gross potential rent and effective gross income.
This is the classic used car salesman tactic of real estate.
Explain the difference between those two terms.
Gross potential rent is the fantasy number. It is the absolute total possible rent you could collect if every single unit was full, every tenant was paying the top market rate, and nobody ever moved out or stopped paying. It assumes 100% occupancy, 365 days a year.
It's the in a perfect world number.
It is. It's like a car manufacturer saying, this car can get 50 miles per gallon if you only drive it downhill with a tailwind.
Right. So what is effective gross income?
That is reality. That is the actual rent that was collected and deposited in the bank. It accounts for vacancies. It accounts for the fact that Unit 3B was empty for a month between tenants. It accounts for bad debt, the guy in 2A who just stopped paying his rent 3 months ago.
So let's play this out. I'm a seller. I want my property's GRM to look as low as possible because we said low is good for a buyer. Which rent number am I going to use in my calculation?
You are going to use the potential rent every single time because it's a bigger number.
Right. A bigger denominator means a smaller result in the final division.
Exactly. Let's say the price is $1 million. The actual effective rent collected was $100,000. The real GRM is 10.
Okay, a GRM of 10. That's pretty decent.
But the seller on their marketing flyer says, oh, but if you fixed up the basement and rented it out and you raised rents on everyone else to the absolute maximum, the potential rent is $200,000.
So they take the $1 million price and divide it by their fantasy $200,000 rent, which gives a GRM of 5.
And suddenly the deal looks absolutely amazing. A GRM of 5. I have to buy this.
But I'm buying a fantasy.
You are paying real money today for imaginary rent that might never materialize. Mixing these two up leads to catastrophic valuations. The source is very clear. You must observe multiples at comparable properties that have actually sold to get a baseline, and you have to know, did that building sell based on what it was making or what the buyer hoped it could make?
So the rule is, never trust the marketing flyer.
The rule is audited financials only. a T12, a trailing 12-month profit and loss statement. Don't tell me what it could make. Show me the bank deposits. Use the effective income for your GRM, not the potential. Unless.
Doesn't unless.
Well, unless you're a professional developer and your entire business model is buying broken buildings and creating that potential, but that's a different game. For the average investor, stick to reality.
Stick to reality. I like that. Which leads us to our final and maybe most sobering reality check. Section 7, the shortcut critique and the DCF model. We've spent a good chunk of time talking about how useful GRM can be as a quick filter, but our source material takes a pretty sharp turn towards the end.
It does. It basically stops being polite and starts being very academic.
It calls procedures like GRM and cap rate shortcut procedures. That phrase alone feels a bit derogatory.
It's meant to be.
And then it drops the hammer, and I'm quoting directly here. As causal models of asset value, they are at best simplistic and at worst incomplete and sometimes misleading.
At worst, misleading. That is the academic way of saying this tool is dangerous and can make you lose your shirt.
So if GRM is the dangerous, misleading shortcut, what is the correct way? What is the model that the pros use that isn't misleading?
The source points to what's called the multi-period discounted cash flow procedure, or DCF.
Multi-period discounted cash flow. Okay, that sounds like something you need a PhD in finance to calculate.
Or at least a very, very good Excel spreadsheet with a lot of tabs.
How is it different from GRM? Can you use an analogy for me?
Sure. GRM is a Polaroid snapshot. It's instant. You press the button and you get one picture of one moment in time, today's price, today's rent. It's completely static.
Okay, a snapshot. I get that.
DCF is a full-length documentary film. The source says it looks at the more complete multi-period total return perspective. It forces you to project the entire movie of this building's financial life for the next 5, 10, or even 20 years.
So it's not just asking, what's the rent today? It's asking questions like, what will the rent be in year 3? What happens when the roof inevitably fails in year 5? What happens when the special property tax abatement expires in year 8 and taxes double?
Exactly. It projects all of those future cash flows, both positive and negative, and then it discounts them back to what that future money is worth in today's dollars, because a dollar in 10 years is worth less than a dollar today.
That sounds incredibly complex.
It is, but it's how true fundamental value is determined. The source gives a very specific high-value example. A property valued at $18,325,000.
That's a very, very specific number. Not 18 million, but 18,325,000.
Now, a broker, a salesperson, might look at that deal after it closes and say, oh, that property traded at a 5.46% cap rate, or it traded at a GRM of X.
And we, the observers on the outside, think, okay, so the market value was determined by that cap rate. People wanted a 5.46% return, so they paid that price.
But the source says that is a fundamental causal misunderstanding.
Causal, as in cause and effect.
Right. The building isn't worth $18 million because the cap rate is 5.46%. That's getting the cause and effect completely backward.
So explain the true causality. What actually happened?
The investors who bought it, they did the DCF. They built the movie. They looked at the 10-year cash flow projections. They argued about inflation assumptions and future tax rates. They calculated the risk of the neighborhood. And that complex, forward-looking model spit out a number. Based on our projections, this building is worth $18,325,000 to us.
So the DCF calculation caused the price?
Yes. The longer-term total return perspective, the DCF, caused the value. The cap rate and the GRM are just, and this is a quote, a reflective representation of all that deep underlying work.
A reflective representation. That is deep. That's a great phrase.
Think of it like a shadow on a wall. The DCF is the object itself, the complex three-dimensional reality of the investment with all its textures and flaws. The GRM is just the simple two-dimensional shadow that object casts on the wall.
And if I only look at the shadow?
You might get the general shape, oh, it's big, oh, it looks tall, but you can't see the texture. You can't see the color. And, depending on where the light is, a shadow can be very distorted.
So the GRM is the shadow on the napkin. It's useful because I can see it from across the room at the diner, but I shouldn't ever buy the building based on the shadow alone.
Exactly. You use the shadow to decide if it's worth walking over to the wall to actually look at the object up close.
I love that. It puts the tool in its proper place.
Yes.
It's not the Bible, it's the brochure.
The brochure. That's a good one.
Okay, we have covered a massive amount of ground today. From the back of the napkin to the philosophical nature of value shadows. Let's try to bring it all home with a quick recap.
Sure, let's do it.
First, Gross rent multiplier. The formula is price divided by gross annual rent.
And remember, that's effective gross income. Use the real rent you actually collect, not the fantasy rent from the flyer.
Second, it's a measure of time. It's the years to pay back. Lower is generally better, but too low can be a sign of danger.
Third, watch out for the monthly trap. If you see a number like 100, just divide by 12 to get the real annual multiplier.
Fourth, it only works because of uniformity. It's fantastic for comparing apples to apples, but it fails completely when you're comparing brand new apples to old, rotten apples.
And finally, the big one. It is a shortcut. It's a reflective representation. It gives you a hint, but it does not replace the hard, forward-looking work of a discounted cash flow analysis for determining true value.
So here's my final thought for you, the listener. The next time you walk past a for sale sign on an apartment building, or maybe the next time you're in an argument with a friend about whether real estate in your city is a bubble, I want you to do the napkin math.
Do the simple division in your head.
Take the price. Make a rough estimate of the annual rent. And get that number. Is it a 15? Is it a 40?
And if it's a 40, you have to ask yourself, why is someone willing to wait 40 years just to get their initial money back before any expenses? What are they seeing that I'm not?
And if it's a 5, ask yourself the opposite question.
Right.
What is so wrong with this building that they are desperate to get out so fast?
The number isn't the answer. The number is the question.
That is the perfect place to leave it. The GRM isn't the answer key. It's the question you ask to start the real conversation. Thanks for joining us on this deep dive. Go find some shadows and see what's casting them.
Happy investing.